Identifying a sharp price drop before it accelerates depends on recognizing a specific structural shift at a market's peak. This tutorial covers the exact steps to identify, confirm, and execute a trade based on a bearish reversal known as the horn top. This formation captures a precise moment where buyers fail to push prices higher, resulting in an aggressive shift in market control. Recognizing this shift allows you to manage risk or position for a decline before the downward momentum gains speed. The first requirement is your chart setting. The horn top is a weekly pattern. The logic of the spikes does not carry over to daily or hourly timeframes. This chart shows a classic, timely horn top. Look at the upper right section where the price action reaches its high. You are looking for two distinct, tall spikes that tower over the surrounding prices from the previous year. These peaks must sit exactly 1 week apart. This creates a center gap where the price dipped before the second attempt at a high. In this comparison, notice the difference in speed. A standard double top takes months to form a rounded ceiling, whereas a horn top is immediate and sharp. These isolated spikes show the market testing and violently rejecting a specific price level twice in 3 weeks, indicating an aggressive shift in sentiment. The reliability of this setup is determined by the price action leading into it. A horseshape is only actionable if it develops after a sustained period of rising prices. This chart displays the risk of ignoring that context. Notice the descending trend line marking a stock that has been losing value for months. A horn formation appears at the very bottom of this long decline, looking like a reversal signal. However, the price does not drop. Instead, it breaks the trend line and moves higher, invalidating the pattern. A reversal pattern requires a pre-existing trend to actually reverse. Attempting to short a stock that is already at a long-term low often leads to a trap. Once you have identified a valid setup in an uptrend, you must wait for a specific confirmation trigger before taking the trade. Zooming in on the formation, identify the lowest low of the center week. Draw a support line straight across this price point. The trade is only valid when a later weekly candle closes definitively below this line. Avoid the urge to anticipate this move. If the price dips below the line during the week but recovers by Friday, the pattern has not been confirmed. Waiting for the weekly close protects your capital from temporary price fluctuations that do not result in a true trend change. With the trade confirmed, you can use the measure rule to establish an objective point to take your profits. Locate the absolute high of the two horns and the confirmation line. Calculate the pattern's height by subtracting the lowest low from the highest peak. Subtract this distance from your confirmation line to find your final target price. Using a mathematical target removes the guesswork from your exit. You are trading based on the specific volatility of the formation rather than emotion. To trade the horn top successfully, remember the checklist. Use a weekly chart. Ensure the pattern is reversing a long uptrend. And wait for a weekly candle to close below the breakout line. This framework allows you to navigate falling markets by following a disciplined, repeatable set of rules. All trading involves risk. This content is for educational purposes only and is not financial advice. Past results of any chart pattern do not guarantee future performance. In any market environment, the difference between professional execution and gambling is the strict adherence to these types of specific data-backed rules.